Imagine you put $10,000 into a stock. It drops 40% in 3 weeks. Your stomach drops. You can barely sleep. You check your phone every hour. And then, right when the pain becomes unbearable, you sell. 2 months later, that stock is up 80% from where you sold it. That is not bad luck. That is your brain doing exactly what it was built to do. And it cost you everything. Today, we are going to talk about the hidden forces inside your own mind that are quietly destroying your returns, and the one shift that changes all of it. Here is something most finance channels will not tell you. The biggest threat to your portfolio is not the market. It is not inflation. It is not rising interest rates. It is not even a bad stock pick. It is you. More specifically, it is the psychological wiring that evolved over 200,000 years to keep you alive in the wild, but is absolutely terrible at navigating the stock market. Scientists call these cognitive biases, and every single investor, from complete beginner to hedge fund manager, has them. The difference is, some people know about them, most people do not. Let me show you what they actually look like in real life. Let us start with loss aversion. A psychologist named Daniel Kahneman ran an experiment. He offered people a gamble: 50% chance to win $110, 50% chance to lose $100. Statistically, you should take that bet every time. But most people refused. Why? Because losing $100 feels about twice as painful as winning $110 feels good. That ratio, 2 to 1, is hardwired into nearly every human brain. In investing, this means people hold on to losing stocks way too long because selling makes the loss feel real. And they cut their winning stocks too early because they want to lock in that good feeling before it disappears. Now here is where it gets sneakier. Meet confirmation bias. Once you buy a stock, your brain starts doing something disturbing. It begins filtering the information you consume. You read the bullish articles. You skip the bearish ones. You join the Reddit thread where everyone agrees with you. You are not lying to yourself on purpose. Your brain is genuinely protecting your ego from the discomfort of being wrong. The problem is, the market does not care about your feelings. It does not reward conviction. It rewards accuracy. And if you are only reading half the story, you are flying blind with a blindfold you put on yourself. This bias alone has wiped out more retail investors than any market crash. Anchoring bias is one of my personal favorites because it is so invisible. Say you bought a stock at $50. It drops to $30. You tell yourself, I will sell when it gets back to $50. But why 50? Why is that the magic number? Because that is what you paid. Your brain has anchored to an arbitrary price point that has zero meaning to the market. The market does not know what you paid. It does not owe you a recovery. The stock is worth what it is worth right now, not what it was worth when you bought it. Anchoring keeps investors trapped in bad positions for years, waiting for a comeback that logic says will never happen. This one might be the most dangerous of all. Herd mentality. In 1999, everyone was buying .com stocks. Your neighbor was doing it. Your coworker was doing it. The news was celebrating it. And then in 2000, it all collapsed. In 2021, meme stocks went insane. Retail investors poured billions in. Social media was euphoric. And then it crashed. Herd mentality works like a spell. When everyone around you is doing something, your brain interprets that as safety. It feels irrational not to join in. But in markets, by the time the herd has arrived, the opportunity is usually already gone. The people who made money got there before the crowd, not with it. Recency bias is quieter, but just as deadly. It is the tendency to believe that whatever just happened will keep happening. Markets crash in March 2020. People think the world is ending and sell everything. Then markets hit all-time highs a year later. People think the good times will never stop and buy at the peak. Recency bias makes your brain act like the last few months are the whole story. But market history is a long game, decades long. And every investor who has ever panicked at the bottom or bought recklessly at the top has had one thing in common. They forgot that markets have always recovered and they have always corrected. Context is everything. So now the real question, how do you actually fight your own brain? Because knowing about these biases and overcoming them are two completely different things. The first tool is a written investment thesis. Before you buy anything, write down exactly why you are buying it. What would have to be true for this to work? What would have to happen for you to sell? When emotions spike, that document becomes your anchor to logic. The second tool is deliberate friction. Put a rule in place that you cannot make any sell decision in the first 24 hours after a big market move. That pause alone has saved more portfolios than any strategy I can think of. There is one more mental model I want to leave you with. Think of your investment portfolio like a bar of soap. The more you touch it, the smaller it gets. Overtrading is one of the most well-documented destroyers of retail investor returns. Every time fear or greed pushes you to act, you are likely reacting to noise, not signal. The investors who consistently outperform over decades are not the ones making the most moves. They are the ones making the fewest. Patience is not passive. Patience is a strategy. And building the psychological discipline to sit still when your brain is screaming at you to do something, that is the real edge in investing. Your brain is not your enemy. It is just running old software in a very new environment. The market is less than 200 years old. Your psychological instincts are 200,000 years old. That mismatch is not a personal flaw. It is a design gap. And now that you can see it, you have the ability to work around it. If this kind of deep dive into the psychology of money is useful to you, there is a lot more where this came from. Stick around, explore the channel, and keep learning at your own pace. The investors who win long-term are not the smartest people in the room. They are the most self-aware. And you just took a step in that direction.